The first and foremost step in investing for the long term is to define your investment goals. What are you investing for? Is it retirement, buying a house, or funding your children's education? Let's take retirement as an example. If you're in your 30s and your goal is to accumulate $1 million in your retirement account within 30 years, you can calculate how much you need to invest each month to reach that goal, taking into account an estimated annual return on your investments. By having a clear goal like this, you can determine the amount of risk you're comfortable taking and the types of investments that align with your goals. It helps you stay focused and motivated on the long-term outcome you desire. Famous investors like Warren Buffett have emphasized the importance of setting clear investment goals to guide your decision-making process. Let's take a look at an example. Meet Sarah, a 35-year-old professional who wants to retire at the age of 65 with a comfortable lifestyle. She estimates that she will need $2 million in her retirement portfolio to achieve her desired lifestyle. Sarah determines that she has 30 years to reach her goal, which means she needs to accumulate approximately $66,667 per year or $5,555 per month. Sarah understands that to achieve this, she needs to invest in a diversified portfolio that offers long-term growth potential. By having a specific goal and a plan in place, Sarah can make informed investment decisions and adjust her contributions or portfolio allocations as need along the way. Now that you have defined your investment goals, it's time to talk about portfolio diversification. Let's say you have $50,000 to invest. Instead of putting all your money into a single stock, you can diversify your portfolio by investing in different asset classes and sectors. For example, you can allocate a portion of your funds to stocks, bonds, real estate investment trusts, and even a low-cost index fund. Imagine if you had invested all your money in a single tech stock a few years ago, and that stock experienced a significant decline. Your entire investment would be at risk. However, by diversifying your portfolio, even if one investment underperforms, the others can potentially offset the losses and provide a more stable return over the long term. Legendary investor Ray Dalio is a strong advocate of diversification as a risk management strategy. Let's take a look at an example. Meet John, an investor who believes in the power of diversification. John allocates his investment portfolio across different asset classes, including stocks, bonds, and real estate. He also diversifies within each asset class by investing in a mix of large cap, mid cap, and small cap stocks, as well as government bonds and corporate bonds. By diversifying his portfolio, John reduces the risk of being heavily reliant on a single investment or sector. If one of his stock holdings experiences a downturn, the impact on his overall portfolio is minimized by the performance of other investments. Diversification allows John to capture potential gains from different areas of the market while managing risk. As the saying goes, Rome wasn't built in a day, and the same applies to long-term investing. Let's consider the example of investing in the stock market. Instead of trying to time the market and predict short-term price movements, you can adopt a long-term perspective by investing in high-quality companies with solid fundamentals and growth potential. For instance, if you had invested in a well-established technology company such as Apple or Amazon a decade ago and held onto the investment despite short-term market volatility, your investment would have grown significantly over time. This long-term approach allows you to benefit from the compounding effect and the overall growth of the economy. Renowned investors like Peter Lynch and Charlie Munger have emphasized the importance of taking a long-term perspective in investing. Let's take an example of long-term investing in action. Meet Lisa, an investor who believes in the power of holding quality stocks for the long term. She identifies a company with strong financials, a competitive advantage, and a promising growth outlook. Lisa invests in this company and commits to holding the stock for at least 5 years, regardless of short-term price fluctuations. Over the years, the company's performance exceeds expectations, and the stock price steadily increases. By staying focused on the long-term potential of the company and resisting the temptation to sell during market downturns, Lisa benefits from the growth of the company and realizes significant gain. This approach aligns with the philosophy of successful long-term investors who understand the value of patience and conviction. Investing for the long term doesn't mean setting it and forgetting it. Regularly reviewing and rebalancing your portfolio is crucial to ensure it remains aligned with your investment goals and risk tolerance. Let's say you initially allocated 60% of your portfolio to stocks and 40% to bonds. After a year, due to the strong performance of stocks, your portfolio's allocation may have shifted to 70% stocks and 30% bonds. By reviewing your portfolio regularly, you can identify any imbalances and make necessary adjustments. For example, you may decide to sell some stocks and buy more bonds to bring the allocation back to your desired target. This rebalancing process helps you maintain a disciplined approach and avoid being overly exposed to any single asset class. Investing legends like Benjamin Graham and John Bogle have emphasized the importance of regularly monitoring and rebalancing your investments. Let's take an example to illustrate the importance of portfolio rebalancing. Meet Michael, an investor who initially allocated his portfolio to 60% stocks and 40% bonds. After a year of strong stock market performance, his portfolio allocation has shifted to 70% stocks and 30% bonds. Michael reviews his portfolio and realizes that his asset allocation is no longer in line with his risk tolerance and long-term goals. To bring the allocation back to his target, he sells some stocks and reallocates the proceeds to bonds. This rebalancing ensures that Michael's portfolio maintains its desired risk return profile and helps manage the potential risks associated with overexposure to a single asset class. By regularly reviewing and rebalancing his portfolio, Michael maintains control over his investment strategy and ensures that it remains aligned with his long-term goals. Last but not least, one of the most challenging aspects of long-term investing is staying disciplined and controlling your emotions. Let's say the market experiences a significant downturn and many investors panic and sell their investments in fear of further losses. However, staying disciplined means sticking to your long-term investment strategy and not succumbing to short-term market volatility. Warren Buffett, one of the most successful investors, is known for his disciplined approach to investing. He once said, "Be fearful when others are greedy, and be greedy when others are fearful." By staying disciplined and avoiding emotional reactions, you can take advantage of opportunities that may arise during market downturns and potentially generate higher returns over the long run. Let's consider an example of how emotions can impact investment decisions. Meet Alex, an investor who gets caught up in the frenzy of a speculative stock that has been generating buzz in the market. Despite the lack of solid fundamentals, Alex decides to invest a significant portion of his portfolio in this stock, driven by the fear of missing out. Unfortunately, the stock's performance takes a turn for the worse, and Alex starts to panic as the price declines. Fearing further losses, he sells his shares at a significant loss. This emotional reaction not only results in financial losses, but also prevents Alex from participating in potential long-term gains if he had stayed disciplined and stuck to his investment strategy. By staying disciplined and controlling emotions, investors can avoid making impulsive decisions based on short-term market fluctuations. Instead, they can focus on their long-term goals and adhere to a well-thought-out investment plan. And there you have it. 5 valuable tips for investing for the long term. Remember, defining your investment goals, diversifying your portfolio, taking a long-term perspective, regularly reviewing and rebalancing, and staying disciplined are the key pillars of successful long-term investing. Investing for the long term requires patience, perseverance, and a focus on the bigger picture. By following these tips and drawing inspiration from famous investors, you can potentially achieve your financial goals and secure a brighter future. That's it for today's video. If you found these tips helpful, don't forget to give this video a thumbs up and subscribe to our channel for more insightful content. And as always, if you have any questions or want to share your own experiences with long-term investing, feel free to leave a comment down below. Until next time, happy investing.